Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Welcome everyone to another episode of the Executive Real Estate Investing Show. I am your host, Michael Holman. Glad to have you with us for another episode this week. Really excited about today's episode. In fact, it's honestly probably one of my specialties, if I could call it, in the real estate investing world. That's right. We are going to be talking about real estate returns, and specifically real estate returns for the financially illiterate. All right. We're going to go high level. We're going to give a basic overview of the most common returns that you find in real estate investing. So it's going to be really great, especially those who might be a little less versed in real estate financial returns. You're going to want to check that out, and you're going to want to listen to this episode because it's going to give you that high level, that base understanding as you get in further and further into real estate investing. But as always, we got to start with today's executive tip. Today's executive tip comes from an article that I read a little while ago talking about the difference between a founder and a CEO. And I thought it was very, very interesting. And I've seen this example actually many times in my life. The article was stating that a founder is somebody who is really good at wearing a lot of hats, right? They do everything. They're generally one single person running an entire business, or they're one of just a very small team running an entire business. And they like to have their hands in everything. They like to be controlling everything, and they like to be performing a ton of different tasks all of the time. And it's important to understand that's a founder, and it's a mindset. It's honestly a lot of people, they kind of consider themselves either a founder or a CEO. The CEO, on the other hand, is a very good delegator, right? They understand how to leverage people. They understand how to take an entire organization of, 10, 20, 30, 40, 50 plus people and get the most out of every single individual so that collectively they can do more, right? And neither founder or CEO, there's not one that's better than the other, but if you're listening to the show, you are likely somewhere in this category or on your way to being in one of these categories. And it's important to have the self-awareness to understand what you are and to leverage anybody or to get help and surround yourself with another person who might have the attributes that you don't. If you're a great founder and your company starts taking off and getting a little bit bigger, you might need to find that CEO type person to help you to leverage all those people, right? So that you don't find yourself just doing everything all the time. All right. That is today's executive tip. As I stated earlier, we're going to get right into things with financial returns. I want to give all the time that I possibly can so that you can glean as much information from just this high level overview as possible. Okay. So we are going to go ahead. We're going to get started. And one of the most important things about understanding this, why should you even care about financial metrics? Right? That's one of the most common questions that I get. It's something that happens all the time. I get investors who approach me all of the time, and they don't even look at the financial metrics. They look at the numbers, and that's it. They don't ask any questions. They don't understand what's going on, right? They kind of are just like, it's all the same, right? It's just apples to apples. What do? I go look at these 4 or 5 different real estate investments, and whichever one has the highest, X return, I just go with that one. They're all calculated the same. It's all the same thing anyway. And I just have to pull my hair out, right? The former CPA in me is cringing at all of this, saying, what in the world are you doing, right? There's so much meat located just beneath the surface of these numbers, right? And real estate financial returns, right? That's the most common measuring stick used to compare different real estate investments, right? I mean, those are the numbers you're seeing when you're comparing whether you should do one syndication or another syndication, or whether you should buy a certain single family home over another single family home, what you're doing is you're probably, right? I'm gonna call you out here. You're probably just scrolling to some section that says, here's the financial returns, looking at them and saying, oh, this one's better than this one, right? This says 10%, this says 9%, therefore the 10% is better. So it's really important if you're gonna compare projects, especially almost wholly off the financial returns, which I don't recommend, but if you're gonna compare investments on financial returns, it's important to understand those, right? I mean, most people don't even know what an IRR is, and we're going to get into that later. Another reason why you should care, right? I mean, depending on what your goals are, like why are you investing in real estate? That's going to make a big difference on what metrics, what financial returns you should be focusing on, because not all returns are created equal, right? An equity multiple, a high equity multiple might mean a really good thing for someone, but it might not align with someone else's goals. Right? If you're looking for a short-term investment and you're looking for just the highest possible return you can get in the shortest time frame you can possibly get it, having a 3x equity multiple is probably not a really great scenario for you, and it's not something you should be focusing on. But if you don't understand what an equity multiple is, then how can you possibly try and figure out if it aligns with your goals or not? Right? You're just looking at it to look at it, right? You have no basis for that understanding. All right, last reason why you should care. All right, and this is a really, really important reason. The returns that you see are only as good as the assumptions that are used to create those numbers. Okay, I'm going to say that again. The return numbers that you see when you're looking at an investment, whether you created the return numbers, whether someone else created the return numbers, they are only as good as the assumptions used to create those numbers. I'm sure everybody here has heard the term garbage in, garbage out, and it is especially true with returns. Okay, so having a basic understanding of how these returns are calculated, how these returns interplay with each other, starts to give you a lot of insight into the assumptions without even knowing what the assumptions are, right? And I'm going to give you some very specific examples at the end of this episode, right? Where you can look at the numbers and you can quickly start gaining an understanding of what's happening beneath the surface, right? You're not going to understand all the assumptions based off of just looking at the numbers and having an understanding that, that's not possible, but you can at least have a good idea, and you can know the questions you should be asking, right? Whether it's to a seller of a home, whether it's to a real estate syndicator sponsor, right? Whoever it is that you're thinking about investing with, or whatever you're thinking about investing in, you need to understand these. You need to be able to ask the right questions to get to the right answers to make an informed decision on whether you should invest in this particular real estate investment. All right, so there are 4 main returns that we're going to talk about today. And this isn't all of them. Some people will use various terms. I'm just going to talk about how we talk about them here in this company. All right, the first return number, annualized return. And we're going to get into all of these in detail. So don't worry, I'm just going to gloss over what the 4 are. First one, annualized return. The second one, internal rate of return, or IRR. Number 3, equity multiple. And number 4, cash return, or cash on cash return. Okay, those are the 4 metrics that we're going to give a 10,000 foot overview of, right? So that you can really dig in and get an understanding of these. Okay, so annualized return, we're going to start there. An annualized return is when people think of return, that is generally the number they're thinking of. If you don't come from a finance background or an institutional background, when somebody says return, you're probably thinking annualized return. And what an annualized return is, I mean, it's just taking all of the net profit that you get on investment and divide it by the number of years that it was outstanding. All right. So if you invested $100,000 and 1 year later you received $100,000, your initial capital of $100,000 and an additional $100,000, right? You would have a 100% annualized return. Now, that would be amazing. We're not going to, if you find a 100% annualized return, right? Talk to me, because I'd like to invest in that too. What's more common is you're going to see it and it's going to be, okay, you invest $100,000 in a year, you get your $100,000 back plus $20,000. So you get $120,000 at the end of the investment. And then that's a 20% annualized return, because you're taking the $120,000 that you received at the end of the investment minus the $100,000 that you initially invested, because that's just a return of capital. That's not profit. That leaves you with $20,000. You take that $20,000 and you're going to divide it by the $100,000 that was your initial investment. That's a 20% annualized return, right? If you were to invest $100,000 and let's say 2 years later, you received $120,000, okay? You do the same thing. Take the $120,000 minus the 100. That's $20,000 of profit. You're thinking, oh, that's a 20% return. Wrong. Because I now said it's a 2-year time period instead of a 1-year time period. You're going to take that 20% and you're going to divide it by the number of years the investment was outstanding. That's 2. That gives you a 10% annualized return. Okay. This is the most common type of return. It's the kind of return that you'll see a lot of times with the stock market, for example. I mean, don't even get me started on the stock market. The way they show their returns in general, actually, they mostly just take your total return, right? They don't even divide it by the number of years it's outstanding. It makes me sick. You look at it and I get people telling me all the time, I made a 30% return on this stock. And I go, oh, yeah. When did you buy that stock? Well, they're like, well, my stock brokerage account, it says that I've received a 30% return. Can you beat a 30% return? Come to find out, they invested in that stock 20 years ago and it's given them 30% back. Like that is really, really bad. You're getting like a 3% annualized return. You understand that is terrible. That's almost like just go stick your money in the bank worthy. So this is the kind of thing that you'll see. If you want to get your annualized return on your stock, go ahead and go to your stock brokerage account. Take the return number it's showing you, right? Whether it's 10, 20, 30, negative 10, I mean, who knows? Divide it by the number of years outstanding. That is your annualized return, right? So that's a really common number you see. It's really common among smaller investors. So what I mean by smaller, not institutional, commonly referred to as like retail investors, right? These are the people generally like you and me who are going to go in and we're going to invest $50,000 or $100,000, maybe up to $1 million or things like that. But we're not big institutions. We're not professional real estate investment institutions, right? So this is a really common number among that group. The next most common financial metric that you're going to see is internal rate of return. This is the second one we're going to talk about. So it is most commonly referred to as IRR. You almost never hear it called internal rate of return. It's almost exclusively called IRR. It's a lot easier to say. So this is by far the most common metric used among institutional investment groups. And there's a couple of reasons for that. But to give it kind of a back up a little bit, give you a general idea of what IRR is, IRR can be thought of very similar to an annualized return, but it takes into account the time value of money. And you're saying, I don't know what the time value of money is. Well, the time value of money simply states that $1 today is worth more than $1 tomorrow, or in a week, or in a month, or in a year from now, right? So basically having money now is worth more and is more valuable than having money later. So it's an annualized return, takes into account the time value of money, or simply just takes into account time, right? It states the longer your investment is out, the lower your IRR is going to be, because the money that you get later on is inherently less valuable, which is up for debate in some circles, but is less valuable than the money that you receive right now. So like I said, this is very common, extremely common. And if you get into an institutional setting at all, this is the main number that they're usually going to drill down on, right? Institutions want to see this number as high as possible in general. Institutions are generally, they're looking like, in my world, I'm a developer, right? And when I go to an institution, right, and bring them a development opportunity, they really want to get in and get out. They want to get the money in. They want to get the building built. They want to get it stabilized. They want to get it sold, and they want their money back as quickly as possible. So that's really what their goal is in that realm. So the higher the IRR for them, the better, because they're looking to shorten the time frame and get as much profit as possible in a very shortened time frame. So just to kind of compare and contrast annualized return and internal rate of return, or IRR, generally, I mean, in a 1 year time frame, right, or a 1 period time frame, your annualized return and your IRR would be the same. After that, your IRR is generally going to be lower than your annualized returns, simply because it's taking into account time, right? So that's kind of just a general rule of thumb. You can expect your IRRs when you're looking at investments to be smaller than your annualized returns. Okay, let's get into the next type of return metric, and that's equity multiple. Equity multiple is, again, a really, really common one, right? And there's a few different names for this. You'll see it called a bunch of different things. Different groups have little variations, right? There's return of investment. There's return of investment capital. ROIC is a pretty common one. But like I said, we're just going to call it equity multiple. That's probably the most common phrase that you'll see around. And that's what we'll stick with in this setting. So your equity multiple is your net profit divided by your initial capital contribution. Okay, so this is very similar and kind of goes hand in hand with annualized return, right? So what that means is, instead of stripping out your initial capital when you're calculating your equity multiple, you're going to leave it in there, right? So let's just take an example, right? You invest $100,000 in a real estate investment, right? Whether it's a home, a syndication, whatever it is, right? You invest $100,000. A year later, you receive $120,000. Okay. Well, to calculate the equity multiple, you're just going to take 120,000 divided by 100,000. That gives you 1.2, right? You're commonly going to hear this called 1.2x equity multiple. Well, the reason people add the X is because what that means is, if you invested 100,000, you received 1.2 times the amount of equity that you contributed, or that you originally invested, right? So your $100,000 turned into 120,000. If you invested $100,000 and you received $200,000, then that would be a 2.0x equity multiple, right? The equity multiple, like annualized return, does not take into account time. So it is completely unaffected by the amount of time that's associated with the investment, right? It could be, if you got $100,000 and you received $200,000, the equity multiple doesn't care if that was out for 1 year or 10 years or 100 years, right? The equity multiple is going to be the same. So that's a really important thing to note, because like I said, depending on what your goals are, that may or may not be a number that you really should be focusing on, right? Or spending a lot of your time and energy and attention on. We're going to get into that a little bit later, but I want to make sure we get through these high level overviews. Okay. The last return that you're going to see, and I would say the last most common financial return you're going to see in real estate investing is your cash return, right? A lot of people call this cash on cash, average cash return. Call it whatever you want. I'm going to call it cash return. Really, really common. All right. This is simply the amount of distributions or cash that you're actually receiving divided by your initial investment, right? So if you, once again, let's just stick with the $100,000, right? You invested $100,000, and let's say every year, like clockwork, you're getting $6,000 in your bank account from that investment, right? That would be a 6% cash return, or 6% cash on cash return. If you were receiving $10,000 and you invested $100,000, that would be a 10% cash return. This is a number that is really, really common to focus on when you're brand new to real estate investing. This is why a lot of people initially get excited about real estate, right? Is they think about these cash returns, because the cash returns are really the sexy thing out there, right? I mean, that's what everybody's dreaming of. That's what everybody's trying to get to is, I want to own these X number of real estate investments that are all bringing me cash. And then I don't have to work, or I can retire, or I can do any number of things. I can do whatever it is that my goal is. The reason I'm investing in real estate, I can accomplish that with the cash return. So it's really, really common. What you find is you get more and more into real estate investing. A lot of times cash return becomes less and less of an important factor. Not that it's not important, don't get me wrong, but it just doesn't necessarily play as much into the amount of money and how well an investment does, depending on what type of investment it is, right? So like I said, I'm going to get into all of this a little bit later, and we need to get into these relationships, because now that we have a high level overview, right? A high level understanding of these real estate return metrics, we need to get into how do they interact. That is where the power and the value of this whole conversation comes in, right? It's great to just kind of know these things. But like I said, I'm going to reiterate that. It is very important to understand how these interact and what they mean for what you specifically are trying to accomplish through real estate investing. All right. It's important to focus on some of these more than others you're going to find. All right. So let's go through a couple of examples, right? And we'll let this discussion kind of progress as it does. So you're looking at a real estate investment, right? You're thinking, hey, this looks really good. Should I invest in it? Well, let's run through these scenarios and let's see what makes sense, right? Let's see what we can deduct just from the return numbers on what type of investment this is and what it means and how it may or may not align with your goals, right? So you find an investment has a really high IRR, right? Let's say it has a 20% IRR. It's a great IRR, 25%, fantastic, right? Or it has a really high annualized return, either one. But it has a really low equity multiple, right? You're thinking, how could a project that has this high of IRR have such a low equity multiple? Well, what that generally is going to mean, that's going to mean you have a short investment window, all right? Generally, because what's going to happen is because your IRR is affected by time, right? The longer you have your money out, the lower the IRR. So if you shorten your investment period from, say, 5 years to 3 years, depending all other things being equal, your IRR is going to go up. Your equity multiple is not going to change, but your IRR is going to go up, right? So if your equity multiple, your equity multiple might be lower than 1.5. I find that a lot of times in real estate investing, kind of the general gold standard is people like to see right around that 2.0 equity multiple, right? And there's a reason for that, but to not get sidetracked right now, you might find an equity multiple that's only 1.5 with this huge IRR. Well, that's just because they have a shortened investment window, right? And that might bring up some questions, right? Good or bad, right? If your goal is to get as much money as quickly as possible, that might be the perfect investment for you. On the other hand, if you're trying to build like a legacy investment, right? You want something that I'm more focused on the cash return. I want these cash flows coming to me. Well, then a 2-3 year hold period probably, isn't going to do it for you, because then you're just going to get your money back. And now you're going to have to go find another investment, right? Which can be a pain. And if you really like that investment, you don't want to sell that thing, right? You want it to keep kicking off cash. Well, that's what I'm saying. It all depends on what your goals are. So like I said, if your goal is to just accumulate as much money as possible in the shortest amount of time, something like this that has a high IRR but a lower equity multiple might be great, might be perfect for what you're looking for. So that's really important to know. But there's questions, like I said, that come up, that arise from this, right? If you find this type of investment, let's say somebody gives you a 2-year investment horizon, super high IRR, low equity multiple, but they're doing a 300 unit development, there's some definite questions to ask, right? If you're building a brand new building and your investment period is only 2 years, you got to ask, how long is it going to take to build these? Are you planning on stabilizing before you sell? Do you already have a buyer for this property? Right? These are the kinds of questions that you can start asking, because in a 2-year time frame on 300 units, they're barely going to have time. They might even still be under construction if you're not careful, right? They might have just finished construction, just barely. And so to say, oh, well, the second we finish construction, we're going to be completely stabilized. We're going to be completely full, rents optimized. Everything's going to be great. It's going to be fantastic. There's a red flag for you, right? But if you go and say, why only 2 years? What's going on? And they tell you, well, we're a developer, but we don't really like to hold these assets after they're constructed. We already have a buyer lined up who we have, maybe they have an LOI or a letter of intent saying, we have somebody who wants to buy this property at this price as soon as it's done. And that's why we're selling. We don't want to take on the lease up risk. We want to take on the development and construction risk, and then we want to get out, right? Well, those are good questions, right? You need to have those answers when you're investing in a property, in real estate, or else could you imagine, if you went with a real estate syndication who was developing 300 apartment units, and their assumption was that they were going to be, finished with construction in 24 months and completely stabilized, right? Essentially that would mean, depending on where you're at, you might be finished with construction in 12 months and you're planning on stabilizing in 12 months, right? I don't know anybody who's out there building 300 unit apartment complexes from the ground up in 12 months, right? So that would bring up concerns, but you can see how these interact and how these should affect your thinking, right? You don't have to understand necessarily all the details, but you can start forming these questions that are the right questions to be asking. All right, let's go through another scenario. Let's say the opposite of what we just said. You got a really low IRR, but you have this huge equity multiple, right? It's like a 3x equity multiple, 4x equity multiple. It's huge, right? Well, that's going to mean a longer investment period, because your money's out there longer. It's going to be just going to mean it's a longer investment period. That's neither good nor bad. It just depends on what you want and what your goals are through real estate investing, right? If you're trying to create these legacy investments where you have these long time horizons and you just want cash flow, something like this makes a lot more sense than what we just talked about previously, with a 2 or 3 investment window. Right? You might want a long horizon. And so you're looking at it, and here's why this is important. If you look at these two, let's say you had 2 investments that were side by side. One had a really high IRR, really low equity multiple. The other one had a really low IRR and a really high equity multiple. Well, if your goal is to create, this legacy investment is what I call it, right? But these long-term cash flowing investments, you might look at that and say, whoa, this return says 22%. This other return only says 14%. The answer is obvious, right? I should go with the 22%. Well, not necessarily. You got to dig in a little more. What's the cash return, right? That first investment might have zero cash return, right? It might all be based on value creation. Whereas that other investment that showed a 14% IRR, that might have, a really healthy cash return, 7, 8% cash return. And it's just expected to grow. That's a lot more in line. If you're wanting to create this stream of cash flow over an extended period of time, that investment might make a lot more sense. On the flip side, and like I stated earlier, if your goal is to get as much cash as possible in the shortest amount of time, then something like that first investment with the 22%, you definitely go with, right? So it's all dependent on what your goals are, but understanding how these interact, it's so important. Let's go through another one, right? A low cash return. Let's say you look at this investment as a really low cash return, but a really high IRR or really high annualized return. Well, what does that mean? That means that this investment is not relying on cash flows at all, right? Or very little. It's relying on value creation. That's a really important thing to understand, right? If your goal is cash flow, you probably shouldn't invest in a real estate investment that doesn't rely on cash flow. It relies solely on value creation, right? I mean, you think about it like that, it's like, oh, common sense. But sometimes when you're in these investments, it's not that clear, right? And so these are why you need to be asking these questions, right? And once you find out that it's all about value creation, that's great. But now you can start asking, why is it about value creation? What value are you creating? Right? If you're developing a brand new building, is the cost going to be that much lower than market value? Well, you'd hope so, right? I mean, all of my developments, that's the most important thing for me, right? I mean, I rely a lot on value creation. I have very little cash flow because I'm building a project. How am I supposed to pay people when I don't even have an asset constructed? So value creation is really important. But if say you're buying an existing asset, let's say you're buying an apartment building, right? And the apartment building's really nice, right? Or it was newly constructed, right? It's a year old, really nice. And it has these really low cash flows and a really high IRR. That's an investment I'd be looking at that saying, okay, new building, low cash flow, high IRR. That means their strategy is to create value. What value are they creating? There better be something that you can't see off the surface. Because if it's a brand new building, how much are they going to be able to push up rents? I mean, maybe the property management was abysmal, but I mean, you can start thinking about this, right? There has to be another reason, or else they're just making it look better than it really is potentially, right? And that's what you don't want to get into, right? And this is why a lot of people invest with sponsors again and again and again and again once they find one that they trust, because those first few investments, they're kind of nail biters sometimes, right? I mean, you're investing a large sum of cash with somebody who you don't necessarily know super well, right? And so once you find someone that you trust, a lot of times you just keep going because you can trust them, right? And so you don't want to get yourself in a scenario that you do one of two things. You either invest with someone or in a project, whether by yourself, whether in a syndication, whatever the case may be, where the numbers are made to look better than they actually are for whatever reason. Or two, you get yourself into an investment that might be good, but doesn't align with what it is you're trying to accomplish, right? You got to look at those because neither one is good, right? So asking the right questions. Okay, we're going to go over one last scenario. We'll just take the opposite of what we did last time, right? You have a high cash return, but a low IRR. Well, what that likely means is that this project is simply based mostly on cash flow, right? They expect this project to cash flow really well over a long period of time. Therefore, they're holding it longer, right? What are your goals? Ask yourself that as you're getting invested into real estate, and then ask the sponsor how the returns relate to what your goals are, right? And hopefully you can start to see these trends and deduct these reasonings, kind of like what I mentioned. Now that you understand how these are created, right? How these returns generally are established, that allows you to start making some assumptions that don't necessarily give you all the answers, but give you a reason to ask the right questions to the right people. You honestly do not have to have an advanced, mathematics or finance degree to just have a basic understanding of these financial returns and how they are calculated, right? And if you can just take a basic understanding of what these returns are and how they're calculated, and you use them to deduct some of these assumptions and ask the right questions, this is going to help you so much. And it's going to make you an extremely savvy real estate investor. It's going to put you heads above 90% of all the other real estate investors out there. So do it. It's important. And I appreciate you spending this time with me. We will see you next time on the Executive Real Estate Investing Show.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.